Hey, welcome back, everybody. We've got John Easley from Tallus Capital Management. Welcome back again, John.
Thanks, George.
All right, so today we're going to be talking about maximizing your 1031 exchange with a DST or a 721 UPREIT. And just as a quick, hey, here's what we're going to cover overview. John just laid out just a real quick bullet point.
Yeah, so one of the things is that if you own a piece of property and, there's some options, obviously, to sell it, to utilize the 1031 to exchange it into another piece of property. That's commonly used with a lot of folks that own a non-primary residence, a rental, or, they may just own, some land. So, the reason why they would do that is that they get to defer all their taxes. So it's a huge, huge benefit for someone that is simply looking to sell, exchange into another piece of property. And, they get to defer their capital gains, which is a big plus as opposed to selling it and paying the gain and then going into another investment.
Okay, so this is really geared towards the folks that may have owned a property, a piece of real estate for a long period of time, and want to change the investment portfolio or that real estate investment. Somebody maybe wants to be a little more passive investor. Maybe somebody started being a landlord. Is that a good?
Yeah, no, that's very fair. Yeah, I mean, obviously that's one of the primary reasons why an investor will own, a rental or something comparable is to receive that income. But obviously, along with that, comes the maintenance and everything else with it. And so, with an exchange option, especially if you can exchange into a Delaware statutory trust or into a something comparable and receive passive income, it's a big benefit to the seller, just because again, they don't have to deal with the maintenance as opposed to what someone would have to go through when they're dealing with renters.
Okay, let's talk a little bit about that. A Delaware statutory trust, kind of a funny name, and that's the one thing that we always hear. Like a DST, a Delaware statutory. We're not in Delaware. Why?
Right. Yeah.
What the heck? Dive into that a little bit.
Yeah. So it's just simply a trust that is managed by a trustee that owns some. That owns professional real estate, or is a professional that owns commercial real estate. So just it's one of those things where it was created 20 plus years ago, and it complements a 1031, but it offers passive income, just as you mentioned early on. And there's various types of these types of trusts. They can be simply involved with different types of commercial properties. It could be a retail property, multifamily, it could be industrial, and the investors are simply owning this for the purpose of that passive income.
Yeah, including value add. There's a lot of different flavors. So to bring a little bit of clarity to this, when you talk about an investor, we're not talking about just mom and pop. Hey, I own this building. Come on in and be part of my DST. That's not what it is at all, correct?
Yeah, I mean, so when someone's involved with a DST, they're going to be invested with other investors. It's not something where they do give up some control as opposed to owning a piece of property where they own it outright, due to the fact that they're going to be owning that trust along with other investors.
Okay.
So yeah,
I'm gonna dial in a little bit deeper because I can hear future people asking me, well, you keep saying investor, you keep saying investor. We're talking about companies that will have an investment. Let's say that a unnamed company owns a huge piece of property, and they're looking for they're making that into a DST. That value of that property could be $100 million, and it is managed and controlled by or overseen by what governmental organization?
Yeah, so it's going to be over the trust is going to be overseen by the trustee, by the sponsor. Okay, so that there's multiple large sponsors in this space, and they are the ones that are going to be managing and maintaining the trust.
Okay.
So that's all coherent. Like I said, when they underwrite this, you're right, the size of these properties are typically 100 million, give or take, 10 million each way in size. And there's multiple participants that are involved with this type of setup.
Okay. We've talked about some big numbers. What is a minimum investment on average that a DST is allowed to have? And or can you answer that? I know there's restrictions.
Yeah, no, now, depending on the DST, they will all have different set of minimums out there, but I would say in general, it's about 500,000.
Okay. All right. Now, here's the thing for everybody listening. You just heard me say, hey, there are some restrictions. There are some compliance things that John is not allowed to answer. So, John, if I ask one of those questions, please say, hey, George, yeah, that's a compliance question I can't answer. That will be a one-on-one conversation. Is that all right?
Yeah, that's fine.
Perfect. Okay. So let's, so when we talk about, a Delaware statutory trust, we kind of went over that, what it is. Now let's talk about how does it work?
Yeah. So again, when someone is looking to, this is one of these options where you have to identify, if we could just talk a little bit about a 1031. So there's a process when someone is looking to set up a 1031, you have to go through an identification period to identify property. So when you go through that, a Delaware statutory trust, a DST, is going to be identified. And once you identify that, and you then have the obvious option of exchanging into that. But a Delaware statutory trust is, again, think of it as a professional managed piece of property. And as you're looking to utilize the 1031, you have that identified and eventually ready to exchange as soon as due diligence is done.
Perfect. So somebody comes in, they're like, oh, George, you know what? Doggone it, I'm really tired of being a landlord. I just would rather receive income and be kind of a hands-off person. So I'm going to sell my property. I'm going to designate it to a 1031 exchange. And then I'm going to say, hey, I want to go to this DST and I'm going to invest in that. What happens then?
Yeah. So in that DST, now they're invested. There will be a stated amount of income that they will receive. I'm just going to speak generally speaking in this environment, that could be right around 4.5%, 5%. Okay. That income could either come in monthly, it could come in quarterly, but that's going to be stated previously. So, they will understand when they're going to receive their income on a schedule, on a calendar. And, they'll have a pretty good idea, obviously, beforehand of what type of trust that could be. Like I said before, it could be a multifamily trust. It could be industrial trust. It could be a retail trust. So they'll understand the property and how it will generate that income.
Perfect. So to be clear, when they do this, they absolutely get all of the benefits of a full 1031 exchange, that deferral of tax. So they're able to take all of that equity, move it over into another investment, get the appreciation and depreciation benefits of real estate. Is that correct?
That's correct. Yeah, it's still a real estate investment. So the risk
Perfect.
same thing as investing in other piece of properties. That real estate risk and return is there for them.
Perfect. All right. This way it provides clarity so that when folks look at this, I hear the future people. Well, do I get to defer the entire amount? Yes. Do I get my appreciation and still depreciate that property? Yes. And so those will be key benefits. So let's talk a little bit about some of the takeaway or some of the benefits you went over, but let's line item these. Let's walk through each one of these bullet points, John.
Yeah. So again, the deferral of the taxes is the biggest bullet point right there. So you defer, and the other factor that kind of comes into play here is recapture, which is from depreciation. It's just something when someone owns a piece of property for a while, they've depreciated over a period of time, that if they were to sell that, they would have to pay taxes on their depreciation. And that's recapture. The nice thing is that gets deferred into this. So deferral of taxes, and then of course the opportunity to receive passive regular income, and then the fact of the matter is that they turn into a passive investor. So they simply don't have to deal with the hands-on management like they would if they own the property directly. And then the last option, there is a big opportunity if they want to pass the property on to their heirs as well. There's a big benefit, and we can talk a little bit more about that later in the presentation.
I think that's a massive, without a doubt, John. I think one of a massive benefit, not just big. It's interesting, some of the conversations that I personally have had, that have been asked as, hey, okay, so husband and wife, if the husband passes, the wife doesn't have to worry about rental income and property management. She continues to receive, that income, however it is structured. And in the event that, she passes and they're still in the DST, for that to, transfer down to the heirs, again, super clean, super easy, and allows for, a nice transition. Did I get that?
No, that's absolutely right. Yeah, no, there's a lot of benefits to that. I mean, usually you have, especially if you have spousal ownership, or if you have kids that are going to inherit the piece of property, it's nice that that can transfer over to them, so they don't have to deal with the maintenance of the property or of the building.
Good. Hey, just real quick, and again, I know each one is completely different. When somebody moves into a DST, what kind of timeline does each DST, since it's not in perpetuity, what kind of timelines typically are a DST?
Yeah, so when someone utilizes or moves into a DST or invests in a DST, it's a long-term investment. So we're looking at 7 to 10 years out is a typical timeline because once they're invested, for this to kind of go full cycle or for them to exit, the sponsor will need to redeem the DST. So, but we'll talk a little bit about that, and that's the reason why there's an attractive option to shorten that timeline.
Is that the 721 later?
That's 721, correct.
Perfect. We'll get to that one. All right. Yeah. Let's talk a little bit about the limitations of a DST.
Yeah. So the limitations is that it's not liquid, meaning that if you're in it, you have to be expected to be in it for the duration of the DST, which is, like I said, 7 to 10 years. It's not something that you can negotiate the lease terms. It is what it is when you invest in it. And again, this is done in a qualified manner. So we have to adhere to all the 1031 guidelines utilized to invest into the DST.
Okay. All right. Well, I guess the next thing is, what the heck is a 721 exchange then?
Yeah, so that's this is something which makes the DST a lot more attractive due to the fact that after a certain period of time, typically it's 2 to 3 years, there's an option for the sponsor to convert the DST into a real estate investment trust, a REIT. That's something where a lot of investors may be familiar with. They're commonly understood on, just as a income investment for the most part. But it's nice because when that exchange is made, after a short period of time, it could be a year to 2 years after the fact, the investment can then be liquid. The seller has converted the DST into a REIT, and then providing regarding the sponsor's requirements, that REIT then could be sold just like any other investment.
Okay, so again, I hear future people ask me in the background, if that happens and quote unquote it becomes liquid, what happens to the protections of that real estate investment, and are they now considered that a sale, and are there tax implications that come with that?
Yeah, correct. So all the tax implications do come with that. So those tax implications are capital gains in the recapture, in anything else that is affiliated with the deferral would then come back into the sale. So you have to recognize that once that's sold. So
Okay,
yeah.
so before then that becomes quote unquote liquid and subject to those capital gain taxes and whatnot, is the investor, meaning that the person who did the 1031 exchange into the 721, are they given notice so that they can quote unquote sell out of that and then move lateral into a different 721 or a different DST or a different real estate investment, so they don't have that gain and they can retain the real estate benefits?
Yeah. So what happens is the sponsor controls the conversion. They control that with an option. So they convert it. It's known ahead of time. The whole purpose of utilizing a 721 is to really convert the property into the REIT. So once that happens, the nice thing is that the investor now has the control part of when they decide to sell, as opposed to being in a DST where they have to wait for the sponsor to redeem that. And the other nice thing is that the investor can do a partial sell. They don't have to sell the whole thing. So they're simply going to be converted into operating units or shares. And when they decide to sell that, it does not need to be a full sale, a full liquidation. It can be simply a partial. And it also makes it a nice option, again, if they're looking to pass this along to their estate, because the heirs now have an option with a stepped up basis to sell those shares if they want to.
Okay, so the 721 has a 2 to 3 year timeline, more short term. A DST 7 to 10 years, definitely more long term. DST much harder to pull out and change course. Much easier with the 721. Is that a fair statement?
Yeah, that's very fair to say. I would say the biggest distinction between a DST and a 721 also is that you could ultimately exchange into another DST or another piece of property and stay within the 1031 guidelines with the DST. With the 721, once you're converted into the REIT, you have to stay in that REIT. You don't have the option of doing another 1031 exchange. But the whole point of utilizing 721 is understanding that you're going to convert into the real estate investment trust anyways.
That is super important and a very important distinction. When you go into a DST, you can do a 1031 exchange and into another DST, like say into another real estate. If you go into a 721, you know at the end of that game, you're paying taxes. You're moving into a liquid state.
Yeah, if you sell it, you're not paying any taxes. Once it converts, you're fine. You don't pay any taxes. You own. In fact, it's very it's a very unique option to consider. Hey, I'm actually taking this property, and in a couple of years, it's going to convert into a REIT. And again, no taxes are applied until you sell that REIT.
Okay. All right. And that's an important distinction too. So it's not when it converts into a REIT, it's when you sell the REIT.
It's when you sell. Absolutely. Yeah.
Okay. That isn't important, because my first thought was, oh my gosh, if they convert it, into a REIT, all of a sudden now I have tax implications.
Yeah, right.
No. It's when you sell the REIT.
Correct.
Perfect.
And those REITs will typically own multiple properties inside of it. And so think of it this way: it's you're converting more into, instead of just owning one commercial property, you could have 25, 50, 100 other properties in that real estate investment trust, which is nice because you're much more spread out in terms of being diversified.
Okay. All right. Let's delve back into this. So when we talk about diversification, you went over that, I think, really well. Income, what it does and how it works similar to a DST. We have capital appreciation. Can you touch on that one?
Yeah. So capital appreciation comes into play here because once you're invested in that REIT and those properties appreciate, the share price appreciates, you get the benefit of that. That's not the case in a Delaware statutory trust. So, if the REIT appreciates, 10, 15, 20%, you get that same benefit passed on to you.
Okay. All right. We touched on estate planning and of course they get a stepped up basis, which is important. Same identical benefits as a DST when it comes to estate planning.
Yeah, except you have a little bit more flexibility. The heirs are going to receive the step up on the date of death from from the owner. But again, most likely they're going to have more of a flexible liquidation or selling option. So, but same thing, it transfers over. They own the units or the shares of if it's converted into the REIT, they would own that just like any other shareholder.
Perfect. Okay. All right. Well, you know what? What are the limitations? Let's talk about that. You have, the operating partnership units. Distribution income is established by the board of directors, is not guaranteed and may fluctuate.
Sure. It's real estate, right? Yeah, no, absolutely. So it's not, there's no guarantee in this investment. The price of the portfolio can fluctuate just like properties can fluctuate in value. They can go up in value and they can go down in value.
Okay, super important for everybody to understand, because this is a question we get asked all the time. Sure. What are my guarantees? Is there a guarantee with a DST? Is there a guarantee with value on a 721? Or is it subject to, like you said, real estate can go up, real estate can go down, real estate can go sideways. It's subject to, cycles, things like that. Is that safe?
Yeah, that's very fair to say. Again, the nice thing about being invested in the real estate investment trust is that they own multiple properties inside of that. But again, you're still subject to the cycles of real estate.
Okay. All right. Super cool. If I was somebody today and I owned a couple of rental properties and I'm like, gosh, I'm really tired of being a landlord. And in fact, let's just open this up to the two of us here. Here we go. What would be my next steps?
Yeah, just evaluate what your options are. Again, one of the things that we look at when we're talking to people that own rentals is what is their income based on the value of the property today? I mean, let's figure out what the capitalization rate is, and really figure out, what their net income is on the property. And then, just kind of get an understanding of also what their debt is. Do they have any additional loans on that? And then have an understanding of what their taxes are. So once we get a full understanding of what that looks like, then we can look at what their options are. And again, they may want to consider exchanging into another piece of property. They may want to consider these options as well. But it's important to take a step back to make sure they understand, where their current income is and just run a comparison.
Okay. Not sure if this is a compliance approved question here, but somebody's interested in this. They want to know a little bit about you. How do you know about DSTs and 721s and why should I work with you above all other choices, including doing nothing at all?
Yeah, I mean, I would just say we've been in the business for a long time. I'm a wealth manager. I've been in the business since the mid 90s, and we'll simply just take our time to understand where the client is, what they're looking for, and to create a plan as well around if they decide to sell their property, regardless, to develop a plan around that. We want to make sure they have a full understanding of what to expect if they decide to make an exchange, and then make sure that we have a plan around how they're going to utilize their income or how they're going to utilize their estate.
So you are a big picture guy that takes it from the 60,000 foot level and takes it right down to the micro level, so they have a very clear plan. Is that
absolutely? Yeah, absolutely. The planning part of this is very big.
Right. So. For somebody to chat with you, what's the best way for them to contact you?
Yeah, so simple is to just simply go to our website, talluscapital.com. Okay. You'll see me right there as you scroll through the website. Or you can simply email me, john@talluscapital.com.
Perfect. We'll put all that information down.
Yeah, that'd be great. And, or you could even call. Either one works. That will be listed as well. But would be happy to review your situation and see if this option would make sense going forward.
All right. Hey, all John. Right. Again, always appreciate when you come in. Wealth of knowledge, and we'll send this around for everybody to take a look at. In the meantime, have an absolutely fabulous day. All the best to you and your family.
Okay, appreciate it, George. Thank you.
Thank you, John.
All right,
thanks, everybody.
Too. All right.